Hello, guys. So let's start by doing a quick review of how the stock market performed in 2022, and then we can later have an outlook for 2023. So, as you know, 2022 was quite a hard year for the US stock market and also generally the Kenyan market and other emerging markets. I think the major highlight for 2022 was the inflation and the hiking of rates by the Federal Reserve. So for those of you who don't know, the Federal Reserve, commonly referred to as the Feds, the main role is to control the economy of the United States. And the major tool they use to control the economy, they use monetary policy tools. And one of the major tools they use to control factors like inflation is they use interest rates. So what happens is, for those of you guys who have attended previous webinars, you have heard me talk about the Fed pivot. And what's the Fed pivot? There are two ways in which the Fed controls inflation. One way is through quantitative easing, and the other one is quantitative tightening. Okay, so let me repeat that again. So the two ways in which the Federal Reserve controls inflation: the first way is through quantitative easing, the second one is quantitative tightening. So let me describe both. And the shift between the shift between quantitative tightening and quantitative easing is what we call a Fed pivot. So when inflation is high, the Fed will tend to go for a quantitative tightening to try and cool down the inflation in the economy. Okay. When inflation is low, the Fed will tend to go for a quantitative when inflation is high, the Fed will go for a quantitative tightening. When the inflation is low, the Feds will go for a quantitative easing. And the shift between the two monetary policy tools is what we call a Fed pivot. So let me talk about 2022. So for 2022, we had high inflation rates in the US and also globally. And we saw major global banks, not only the Feds, but also the ECB, which is the European Central Bank, and the Bank of England, BOE, raising their interest rates. Okay. So what happens when the Feds raise interest rates? That has a huge negative effect on the stock market, because we usually see a bearish market accompanying raising of interest rates. Okay, that's why when I was talking to you guys at the end of the year, I was telling you guys, as many analysts are waiting for a Fed pivot, we need to see the Fed have a pivot from contractionary monetary policy to expansionary monetary policy, so that we can see, that's when we can expect to see a bull market. But until then, we're still going to see a bearish market in the stock market. Okay, so going quickly through the major highlights of 2022, we had global uncertainties. When we talk about global uncertainties, we're talking about the Russia-Ukraine war, the energy crisis, and the whole COVID issue in China. Okay, so we had global uncertainties. We had tightening of financial conditions. That's what I've mentioned before, the quantitative tightening. We had also supply bottlenecks, which were a huge factor when it came to inflation. When I talk about supply bottlenecks, immediately we had the war and the energy crisis. This had a huge effect on the supply chains, okay? And then we had the depreciation of other currencies relative to the US dollar. And finally, we had the wage rate growth, which is a factor that pushed inflation. Okay, let's look at how the various sectors performed, and then after that, I'll tell you what we're looking for in 2023, and then we can call it a day. So, my plan for today, I want to make it a short webinar, because I think the long part will be today in the evening during the IG live, because we are expecting CPI today. That's the inflation data. And I think when we get the inflation data from the US, then we'll be able to create the narrative for the year. Okay, so looking at last year, the S&P 500, which is the largest benchmark index for the US stock market, had a negative return of 19.44%, as you guys can see on your screen. The S&P 500 tracks the 500 largest companies in the United States. We also had the Dow Jones. The Dow Jones had a negative return of minus 8.78%. The Dow Jones tracks 30 blue chip companies in the US, and we also had the Nasdaq, which mainly has tech companies, having a negative return of negative 33.10%. It was heavily hit because of the tech companies. As you guys can recall from the previous webinar we did, I talked about tech companies and the poor performance for tech companies like Apple, Microsoft, Google, etc. Let's look at the specific sector performance. The best performing sector was the energy sector with a return of 64.56%. And one of the things when it comes to outlook for 2023, there's a whole lot of disagreement. The guys who are saying that we're still going to continue with the energy rally, and the guys who are saying that I think by now the energy sector is overvalued. But for me personally, I think we're still going to continue with the energy rally. And for those of you in our WhatsApp group, remember I sent the analysis for the two companies, for Occidental Petroleum Company, which was the best performing company last year with a return of 117.4%. So go and look at that. So I sent for Occidental and on Monday, and yesterday I sent for Hesco. So look at the two companies and the analysis I did on the two companies. The second best sector was utilities with a 1.57%. So normally these two sectors tend to perform well during inflation. Actually, if I can remember well, the energy sector has had positive returns every time we have had inflation since 1973. Okay, so the third best performing, I wouldn't say best performing, but because it still had a negative return, was the consumer defensive sector with a return of negative 0.70. Then we had the healthcare sector with a return of negative 1.95. We had the industrial sector with a return of negative 5.48. We had the financial sector with a return of negative 10.53. We had the basic materials with a return of negative 12.27. Real estate, negative 26.13, information technology, negative 27.64, consumer cyclical, negative 36.23, and communication services, negative 37.66. For those of you who don't know, let me differentiate the two. So the difference between consumer defensive and consumer cyclical are also called consumer discretionary products. These are products that you can do away with, especially when the economy is hard. So they are more like luxury goods. Yes. So the difference between the two, consumer defensive, we have, let's say, the food products. You still need to eat despite the performance of the economy. So we will put that under the consumer defensive sector. Okay. So for consumer cyclical, these are products that tend to move with how the economy is performing. So if the economy is not performing well, guys will tend to spend less on consumer cyclical products. Let's look at the S&P 500 top performing companies. If you guys can remember, I've told you the S&P 500 tracks the 500 largest companies in the US. You guys can ask your questions on the Q&A section, and then I can answer them as I continue with the webinar. So the top performing company, as I had said, was Occidental Petroleum Corporation with a return of 117.40%. I think one of the things you guys can see is that the top 9 best performing companies in the S&P 500 were actually from the energy sector. Okay, so the energy sector really had one of the best performances last year. So the first one was Occidental, the second one was Hesco with a return of 91.75. Marathon Petroleum with a return of 83.49, ExxonMobil 81.44, and number 5 SLB with a return of 79.28%. One thing you guys are going to note, even when it comes to the ETFs, the ETFs that performed well were the energy ETFs and also the ETFs, the inverse ETFs. So the previous webinar when we talked about ETFs, we talked about ETFs that tend to give an inverse return to the returns of the indexes. So let me go to the ETF so that you guys can see. This document is on your WhatsApp group, so you can refer to it. So let's have a look at the ETFs. So if you can see that the best performing ETF was the daily 20 plus year via 3 times ETF. When you look at 3 times basically means it's a leverage ETF. This is an ETF that the returns are multiplied 3 times. Okay. We also have the Pro Share Ultra Pro Short 20 plus years ETF. So when we talk about a short ETF, this is an ETF that sort of bets against the market. And that's why it was among the best performing ETF, because the market had negative returns. So when you're betting against the market and the market has negative returns, then you're bound to have positive return. Then number 3, we had the daily direction daily energy bull 2 times ETF. When you see the 2 times, this means that the ETF is leveraged 2 times. Okay, let me go through the rates. The best performing rates were Realty Finance Corporation. Number 2 was the Healthcare Trust. Number 3 was the Aspen Digital. Number 4 was the Maxus Realty Trust. And number 5 was the Fibra Hotel. So let me not talk a lot about 2022, because I've already mentioned the issues we had in 2022, namely tightening of monetary policy by the Fed, a surging USD, oil supply chain bottleneck, and geopolitical uncertainties. So let's talk about 2023. I hope you guys are ready. Before I talk about 2023, let me get a question from you guys. You can type a question on the chat section. Okay, so talking about 2023, basically, because we're still in Q1 of 2023, the 2022 trend is bound to continue, basically. I think if you're going to see a change, you're going to see a change in 2022. So the main issue in 2023 will be interest rates. And as I've told you guys, today at 4:30 p.m., we're expecting CPI, which is the US inflation data. And this is going to set the tone for the year, because we need to see the Feds. Actually, the main thing the Feds are looking for, they're looking to reduce the wage growth rate as we head into 2020. As we head into Q2 of 2023. And so for today, the consensus among most banks is that we're going to get a CPI of around 6.4%. Actually, let me mention them. For JP Morgan, the CPI estimate is around 6.4%. We have Morgan Stanley 6.4%. Goldman Sachs 6.4%, Citi is quite high, 6.5%, Barclays 6.4%, and basically the average is 6.4%. And so the thing is, if we get a reading of more than, if we get a reading of more than 6.4%, then we're going to have a reading of more than 6.4% is going to cause a surge of the US dollar, okay? So we need to get a reading of less than 6.4% so that we can see cooling down of the US dollar and cooling down of inflation as we anticipate the FOMC on the 1st of February 2023. Okay, some of the factors that are going to be key for 2023, let me mention the first one. The first one will be the China's reopening. So as you guys know, in the document I sent last week, the China's reopening has been a big factor, especially when looking at the Chinese tech stocks, okay? So if I can remember well, the first 3 days of the US stock market, some of the best performing companies were actually Chinese tech stocks that are listed in the US stock market. And there's a high chance that this is going to continue because China has been in a lockdown for the past 3 years. And so China being the second biggest economy, then this is going to be a huge factor, especially for the tech stocks. And that's not the only headwind. That's not the only tailwind that we have. The second tailwind that we have is during 2020, the 2020 period, there was a major crackdown on major tech companies in the US, in China. Lately we have seen a more accommodative government, a more accommodative Chinese government, during a period where they want to support the local businesses, they want to support the local tech industry. And this is going to be huge for companies like Alibaba. If you can remember, it all started in 2020 when Jack Ma criticized the financial system. And from there, it was hell broke loose for the tech companies. The major tech companies have been experiencing a lot of backlash from the government. Seeing the pivot from the government and the change of policy, we're seeing a government that is ready to support the local businesses, especially the tech sector, and this is likely to boost the tech companies in China. And so, heading into 2023, one of the major asset categories investors are looking at is the tech companies in China. Another sector that investors are looking at is consumer goods, and that's where we bring in luxury goods like LVMH. As I've mentioned, China is the second biggest economy in the world. And so what happens when the second biggest economy in the world is reopened and guys are now, if you can remember, guys were not being able to travel into China for like 3 years. So we're experiencing a situation where most guys are going back home. They're not seeing their families in like 3 years. So we're going to have a lot of consumption. I mean, a lot of consumer goods being purchased by guys. And that's why many investors are looking to invest in consumer goods in China and consumer goods, and they have increased their estimates for the performance of companies like LVMH because of that reason, the China reopening thing. Okay, so that's the one factor which is going to have a huge effect looking to 2023. Another factor is going to be the energy sector. Looking at the energy sector, as I had mentioned when we were starting, the big question is, has the energy sector performance peaked? Are we going to see the energy sector have more positive returns this year, or is it over for the energy sector? And recently, the International Energy Agency increased its oil demand forecast for 2023 by 300,000 barrels a day, mainly due to the reopening in China and also new demand from new markets in Asia, like India. Okay, so the consumption is expected to grow by 1.7 million barrels a day to reach 1.6 million barrels a day. So this is going to increase demand for oil, and this is going to be a major tailwind for the oil industry. And that's why I told you guys at the beginning of the webinar, for me, I'm still bullish on energy stocks. I think the bull run is still not over, and we're going to see more upside movement of the tech stocks. Even looking at the technicals, I think I've sent two charts so far. I've sent the chart for Occidental. I've sent the chart for Herscope. Let's look at Occidental. If you guys can refer to the chart I sent on your WhatsApp group, you're seeing Occidental forming a descending channel, and the company has been in an uptrend, and the company is now forming a descending channel, which is a really bullish chart pattern. And so for me, I think heading into 2023, I'm still bullish on energy stocks and bullish on Chinese tech stocks. Okay. Looking at the CPI, the CPI gained 71.1% year over year in November 2022, and we had peak inflation in June at 9.1%, and we also had the PCE, which is the personal consumption expenditure index, increasing 5.5 year over year in November, down from 6.1% in October. Please note that the PCE is usually the preferred measure of inflation for the Feds. And so we begin to observe these major reports to get a narrative of where we headed in 2023. So one of the things I'd like you guys to watch, I want you guys to watch the we had NFP last week. So watch the CPI data, watch the FOMC data, and at most watch basically the sentiment of the Fed. A hawkish Fed will be bad for the stock market. and a dovish Fed will be good for the stock market. Okay, so talking about 2023, we have talked about the interest rates. We are expecting a Fed pivot, let me say around Q2, Q3 of 2023 from a quantitative, from a more tightening more of monetary policy to a more expansionary monetary policy. So that's the first point. The second point, we are expecting the China reopening to boost demand of consumer products, especially the luxury products like LVMH. And also we are expecting the performance of the Chinese tech stocks to be boosted by the change of policy by the Chinese government. So the first one is a Fed pivot. Second one is boosting of the performance of consumer goods because of the reopening of China. And third one is boosting of the performance of tech stocks because of a change in policy by the Chinese government. Okay. Another factor we'll be looking at is earnings. We're going to start the earnings season tomorrow. I mean, mid-January, and tomorrow we're going to start with the major Wall Street banks like Citigroup, JP Morgan, and so we begin to observe how are the banks performing. If you guys can remember, Goldman Sachs recently cut around 3,200 jobs, and so we'll begin to observe how our financial companies performing as we expect a recession in 2023. Okay, so those are going to be the major points of interest right now. And so for me, my advice for you would be, if when it comes to investing right now, the best approach would be a more defensive approach to investing. And what do I mean by a defensive approach? For a defensive approach, you need to go for companies with strong balance sheets, strong balance sheet. And also you need to go for companies that pay dividends. And you need to go for companies that have more market dominance, and also need to go for companies that are resilient to inflation, because until as of now we don't see an end to inflation, because we're still seeing a strong jobs data in the US. So it will be keen to watch how will the jobs data reflect on the state of the US economy. Just remember, the labor market is a lagging indicator, so we might not see the results immediately, but it's still an important piece of data. Okay, so for today, let me mention that again. Look for companies with strong balance sheets, look for dividend paying companies, and invest in a value basis, and look for businesses that are resilient to inflation. Okay, basically the approach should be a more defensive approach. And when you talk about defensive approach, you need to look at the healthcare sector, utilities sector, and also the energy sector, because the energy sector has historically performed well during inflation. Okay, so for today and tomorrow, that's Thursday and Friday. So for today, we're watching CPI. For the guys who will attend our Instagram live at 7 p.m., I'll update you on the CPI data we have gotten, because we're going to get the CPI data at 4:30. So I'm going to update you on the CPI and how the markets have reacted. Tomorrow, we're expecting the earnings from the bank. I'm also going to update you on that. So I think that's it from me, unless you guys have any questions. Okay, someone is saying kindly send the link to the WhatsApp group you mentioned. Okay, Sasa, let me type my number, and then you can on the chat, and then you can text me on WhatsApp, and then I can add you on the group. So that's my number. Text me on WhatsApp, and then I'll add you on the group. So that's it from me. Have an amazing day. Join me today at 7 p.m. This was quite short, because I don't think there's a lot to talk about now until we get the CPI. And then after we get the CPI, we'll have a more clearer sentiment for 2023. So remember to stay defensive, go for companies with strong balance sheets, and companies that pay dividends, and companies that are resilient to inflation. Also watch out for the Fed pivot, watch for the sentiment of the Feds. When you see until you see a more dovish Fed, then that's when we can expect a shift in the stock market from a bull run to from a bearish run to a bull run. Okay, so I think that's it for today. Join me today at 7 p.m. for the Instagram live, and you have an amazing day.